It's interesting, we were looking at some of the existing home data yesterday, Stephen, where you had supply ticking up, days on market ticking up, and now you got told with this average order price miss. Are we seeing some inflection here in the trends?
No, you're not. Certainly not in the trends that can reflect what had been going on through July. I think Diana put her finger on it. You have mixed issues that are going on in an environment where rates have been elevated. The builders are doing what you would expect them to do, which is adjust what they build to make sure that they're achieving affordability. In the case of Toll Brothers, you have some geographic mix going on that I think the CEO did a good job explaining just about 30 minutes ago on their conference call. So you really shouldn't read into that. The bottom line is that all of their forecasts for all the relevant metrics, whether it be revenues or closings or orders or gross margins, they're all going higher. So estimates are going higher for Toll. That's why the stock's up. This is very much consistent with what we've seen for pretty much all the builders over the last few months. But what's going to be interesting, I think, going forward here, because it's all about, stocks are all about what's going to happen, not so much what did happen, is what's going to happen now that mortgage rates have hit a level higher than they were even in the fourth quarter of last year. And so I think the stocks would be up a lot more today if it weren't for concerns that the mortgage rate could maybe change things in August and September.
Right. Explain some of those geographic changes that Toll was laying out.
Well, for Toll specifically, you have to remember that they're a high-end builder, right? Their average price is about double any other builder, right? So they're basically catering to the luxury end of the market. And what they've been doing over the course of the last several years is moving into some geographies and offering some product lines, product types that cater to a buyer with maybe a little lower ASP in mind. And so they've been deliberately making a mix shift, and that has taken them into some markets like away from the coast, for example, which will naturally bring a lower ASP. So it really doesn't demonstrate a weakening or anything like that of trends, as much as it just reflects a little bit of movement in terms of where they're selling. That's all.
Dan, I'll let you jump in here.
I'd be interested, Stephen, to know when we talk about these incentives. The builders had been doing a lot of incentives last fall and into the winter to get buyers back. But then in the spring, they said they really didn't need to do incentives anymore because there was just so much demand. In the past month, though, on the Builder Sentiment Survey, we are seeing builders talk about incentives again, buying down those mortgage rates. That hits their bottom lines. How much can they do on these incentives, and how long can they do it for?
Yeah, that's a really good point. And so I do definitely think that you will see rate buy-down activity increase, particularly for builders that are catering to a more affordably minded buyer. There are limitations. There's a limit on how much a home seller can gift to a buyer and still qualify for various mortgage products. For example, an FHA mortgage, you can gift them about 6% of the loan value, for example. That's your limit, and things like that. So there are limitations there. But I do believe that you're going to see the builders increase their activity there if rates stay here or move higher. And that will put some pressure on their gross margins. And I think that most investors, should be pretty clear-eyed about that. On the other hand, we are still seeing that there is still ample demand for the product that they are selling. So the outlook for 2024 and the earnings per share, we think are still going to be moving higher as we go into next year. Remember also that most of these public builders, including Toll, have done a wonderful job shoring up their balance sheets. So you saw Toll, for example, get more aggressive with their share repurchase activity. And I think that that's something that you can also look forward to as you head into next year.
Stephen, just to follow up on your kind of outlook for 2024, what happens to this whole dynamic if we do start to see a cut in rates?
Well, a cut in rates. So a reduction in mortgage rates is just good for home building demand. It increases affordability, and it makes all kinds of things look better. It basically gives the ability to raise prices or reduce incentives in the industry, because it doesn't actually do anything to increase the supply instantaneously, right? So it increases the demand. The supply is the same, and that has a very positive effect on your price, and that means better margin. So lower rates as we head into next year would be nothing but good for the builders. There is a false narrative out there that perhaps if rates go down, that you're going to see a whole bunch of people put their house on the market. That might increase inventory, and that's bad for Don't believe any of that. That's not true. That you might see more people decide to move, but that means you're also going to see more people look to buy, because a mover is a buyer and a seller. Their impact on the inventory isn't particularly significant. But I would say that lower rates, no question, better for builders next year.
I guess it depends on whether they buy or rent where they're going. I guess that's a dynamic we'll have to see flesh itself out. Diana, Stephen, thanks, guys.